Happy Tax Tuesday, everybody. I know those words are rarely said together, happy and tax, but regardless, today is April 15th, 2025, and this is your Tuesday market update. Now, due to the Passover holiday yesterday, markets were open, but we were not, and thus no Monday market update. Sorry about that. I hope you were able to catch the Thursday special market update and the Friday planning video last week. This week, we're going to have today's video and then a planning video on Thursday, since the markets will be closed on Friday for the Good Friday holiday observance. So buckle up, or as they say, remain seated with your seatbelt securely fastened. Since I reviewed Monday through Wednesday's market action on Thursday, check the YouTube channel for a review of that if you missed it. I'll just wrap up last week, get this week started, and we'll preview what's left to see this week, at least that we know of left to see this week. After Wednesday's historic rally, markets pulled back on Thursday, digesting some of the gains as traders weighed renewed tariff worries. A cooler than expected CPI report could have been a bright spot, but the mood remained cautious as the focus stayed firmly on U.S.-China trade tensions and the broader uncertainty around tariff policy. Bond yields rose, the dollar slid, and markets seemed to be signaling concern not just about the tariffs themselves, but the underlying confidence of the U.S. economic leadership. Dow closed down 2.75%, S&P down 3.5%, and the Nasdaq gave up over 4% on the day. Markets did steady on Friday, helped by a modestly encouraging read on the producer prices. That's the PPI, which, of course, like the CPI, surprised on the downside. Despite early weaknesses and a drop in consumer sentiment to its lowest level since 2022, the tone shifted midday following a Financial Times report suggesting that the Fed was ready to step in if needed. That hint of a Fed backstop did help lift sentiment, and stocks closed the week on a high note. For the day, the Dow was up 1.5%, S&P rose 1.75%, and the Nasdaq gained a bit under 2.25%. Now, before we move into this week, yesterday's move, and the preview of what's left, I want to share some thoughts. Like everything, just an opinion, but here are 3 takeaways from last week. Now, first, the Trump put seems to be alive and kicking. Last week, this administration adjusted tariff policy in response to falling markets, first with a 90-day pause, excluding China, and then with weekend exemptions on consumer electronics. Now, while the execution has been chaotic, the bigger takeaway is this: Washington is watching the markets, and they're willing to step in to avoid a total breakdown. That doesn't eliminate uncertainty, but it likely removes the worst-case crash scenario, at least for now. Number 2, tariff relief does not equal market clarity. Yes, a market crash may just be off the table. We don't know, but this is far from a green light environment. Policy remains unpredictable, especially regarding China, and that kind of uncertainty keeps markets jumpy. Until we get a clearer direction on long-term trade goals, it's hard to make out the case for a sustainable breakout. Number 3, watch the bond market and the dollar. Stocks may have calmed, but the real story might be in treasuries and currency. The 10-year yield spiked late in the week, and the dollar dropped to multi-year lows, moves that typically signal eroding global confidence. Now, these aren't just market noise. When core global assets like the U.S. dollar and treasuries behave so erratically, it raises red flags. If the 10-year yield pushes above 4.80% or the dollar falls further, these may be signs of deepening stress and the potential headwinds for equity. I will add one more. That is not really a full takeaway, just another possible one. Powell and the Fed hold fast to the wait and see plan, but as we saw last week when we got the rumor and denial of the 90 days, then the actual news, usually where there's smoke, there's fire. The Financial Times did report on the Fed ready to backstop. We will see if anything really pans out from there. Now, despite a tumultuous week, the 3 major averages all notched solid gains in the period. The Dow was up nearly 5%, S&P up 5.75%, and the Nasdaq up 7.33%. These are weekly, not annual numbers. The 3 major averages do remain lower since April 2nd, when the White House announced reciprocal trades on goods from other countries. Since then, they are all down about 5%. Now, let's preview this week. We started the earnings beauty pageant last week with the banks, and they're strong again. And again, yesterday, we got some more banks, mostly, and they crushed expectations, but some warnings did not sit well. We will get a pretty good group of earnings this week. No major benchmarks to speak of. We will get Netflix, and that usually brings some movement on that stock. We'll get some housing as well as jobs data to add to the earnings, but don't forget the Fed heads. Bingo cards out. Ready? Waller, Harker, Bostic, Cook, Hammock, Schmid, Logan, Bahar, Daly, Goolsby, and yes, even Powell himself. I do think that if there is even the hint that the Times article was correct, this market could take another leg higher, but that's just a thought. We'll see what happens. I do think another one of the biggest numbers to watch this week will be tomorrow. Retail sales are due out, and they will tell us, are we still losing growth momentum? Think slowly applying the brakes as you coast downhill, or have we hit a wall or gone off the cliff of growth? Retail sales should give us some more information to back up the warnings. And one more stat to keep in mind and note for any thoughts when you see these markets shift in big ways. The first few days of April saw investors put more than $60 billion into money market funds. Estimates now that those money markets are sitting at $7.5 trillion. And when some of that money moves, you may feel it or see it. Finally, one more thought on the tariffs. Goldman Sachs, assuming that the tariffs, as we've heard them, the new vehicle net prices in the U.S. will go up by $2,000 to $4,000 over the next 6 to 12 months. Boston Consulting Group estimates that the tariff will add $110 to $160 billion in cost to the industry per year. Now, those are real estimates and real numbers. That's why all of the calendar information is secondary to what's happening with the 90 days negotiations and all of the comments from the Fed and the president. There's a lot to see this week and beyond. Just 3 trading days left this week. As always, it'll be best to get a plan, to revisit that plan when necessary, but reacting to every headline is rarely the best plan of attack. So please keep in touch if you have questions about how your plan is being affected. For now, have a great week, and we'll see you on Thursday for the planning video and back next Monday for an update.